What lenders actually look at when approving rental property loans is very different from what most investors think. Most investors believe loan approval is about income, tax returns, or how good the deal sounds. It's not. Lenders look at structure first, then risk, then numbers. Let me break this down the way it actually works. The first thing lenders look at is the property, not your story. The property is the collateral. That is what secures the loan. Because of that, lenders care more about the property itself than your background. They focus on location, condition, rentability, and market demand long before they care about what you do for a living. They ask very practical questions. Is the property in a stable market? Is there consistent rental demand? Is the property clean and functional? Is it something they could sell if they had to? A clean property in a stable market will almost always get better terms than a risky property with a great pitch. That is why two investors with similar profiles can get very different loan outcomes. The difference is usually the deal. Second, lenders look at cash flow, not appreciation, not future renovations, not what the rent might be next year. They look at real numbers, actual income versus actual expenses. They want to see that the rent can comfortably cover the mortgage, taxes, insurance, and reserves. Not barely cover it, comfortably cover it. This is where DSCR comes in. DSCR measures whether the property can pay for itself. If the property supports the debt, the loan becomes easier to approve. If it does not, the lender is taking on more risk, and lenders do not get paid to take unnecessary risk. At this point, if you are working on a rental deal and trying to understand DSCR loans or funding options for real estate, feel free to send us a DM. We can look at the structure and tell you quickly if it makes sense. Third, lenders look at leverage. Loan-to-value matters more than most investors want to admit. Lower leverage gives the lender more protection. Higher leverage means the margin for error gets thinner. Lower leverage equals lower risk. Lower risk usually means better pricing and faster approvals. Trying to squeeze every dollar out of a deal often creates problems. More conditions, more scrutiny, more delays. In some cases, it kills the deal entirely. Fourth, lenders look at the exit. Not just what you plan to do, but what happens if things do not go as planned. If rents soften, if the market slows, if you need to sell, can the property be sold? Can it be refinanced? Is there enough equity to protect the lender? Lenders underwrite for downside scenarios, not best-case outcomes. This is where experienced investors separate themselves from beginners. Beginners focus on upside. Professionals focus on durability. Finally, lenders look at you. Your credit, your experience, your ability to execute. But here's the truth most people miss. If the deal is strong and structured correctly, the borrower becomes less important. That does not mean credit does not matter. It means structure matters more. That is how professional investors scale. They focus on repeatable deal structures that lenders understand and trust, instead of relying on perfect personal profiles. The takeaway is simple. Rental loans are approved on structure, not optimism. If you want rental or DSCR loans approved consistently, focus on clean properties, real cash flow, reasonable leverage, and clear exits. If you are working on a deal and want help structuring the financing, send us a DM or comment funding. That is what lenders actually look at.